Yesterday, the Federal Reserve issued their FOMC statement, and we got an awful lot of information and an awful lot of things that we need to digest as investors. But some really important things came out. There wasn't too many surprises in there. There were some things better than expected, some things worse than expected. We also got our principles for reducing the size of the Federal Reserve's balance sheet, which we're going to be speaking about today. But before I even explain what we're going to be speaking about today, I got a few questions today asking, why did stocks sell off when there wasn't too much of a surprise yesterday? And it's quite funny that it was largely due to the fact that the US economy is actually stronger. It's stronger than expected, and unemployment levels are better than expected. They've been getting better and better very quickly. And what that means is that the Fed can speed up the timeline of raising rates, of, everything they've been doing to keep the markets up. And Jerome Powell did say this himself, and he said a lot of things along these lines himself. And when he started to say these things during the Q&A session, that's when, some of these sell-offs were happening. So a lot of it's actually due to some very good things, funnily enough. Things like GDP grew at a 6.9% pace to close out 2021, stronger than expected despite Omicron spread. The US economy grew at a much better than expected pace to end 2021, through the acceleration likely tailed off as the Omicron spread put a damper on hiring and further hindered the global supply chain. So GDP better than expected. Right now, we see more than 85% of NASDAQ 100 stocks are in a correction. This is a level of wipeout that has led to a rebound 100% of the time, assuming you ignore 2002 and 2008. So I just want to speak about what I personally believe some of the most important things we got from yesterday were, and I want to try and make it really simple because I know you can really overcomplicate these things and there's no need. So that's why I wanted to do that little thing at the start of the video, just to explain why that sell-off happened really quickly. Really quickly, could I ask you guys, please hit that juicy like button, drop me a comment down below, let me know what you are doing with your portfolios, and please, my friend, subscribe if you're new around here. Also, if you would like 5 free juicy stocks, check out the pinned comment, check out the first link in the description. I'm now affiliated with Moomoo. You sign up, you can get 5 free stocks worth up to $3,500 each. You get 1 just for opening an account. You get 1 if you deposit as little as $1, and you get the rest if you deposit $2,000. They have 0% commissions on US stocks for US customers. They have free level 2 data. They have extended trading hours. This is the best sign-up deal I personally have ever seen. And you can literally go get 2 free stocks for $1, test out the app, and see what you think. So Federal Reserve issues their FOMC statement, okay? Indicators of economic activity and employment have continued to strengthen. The sectors most adversely affected by the pandemic have improved in recent months, but are being affected by the recent sharp rise in Roni cases, which are again starting to come back down. Job gains have been solid in recent months, and the unemployment rate has declined substantially. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. Overall financial conditions remain accommodative, in part reflecting policy measures to support the economy and the flow of credit to US households and businesses. Now, we have to keep in mind, guys, we're speaking about the Fed, okay? Their main priority is not the stock market. It is not making me or you money in the stock market. It is not purely getting it up as high as possible. The Fed wants to prevent inflation from getting out of control far more than they care about your stocks. They care much more about keeping employment levels as close to maximum than keeping your stock gains to maximum. That's the Fed's job, and we have to remember that, okay? Because a lot of time, especially when we speak about quantitative easing, when we speak about all these things, we think that the Fed exists sometimes just to make us money, just to make stocks go up. It's not the case. Now, sometimes they do have that effect, and that is part of their job, but it's not their main priority. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run, so we should all be aware of this. In support of these goals, the committee decided to keep the target range for the federal funds rate at 0 to 0.25%. With inflation well above 2% and a strong labour market, the committee expects it will soon be appropriate to raise the target range for the federal funds rate. Okay, so when things like this get said, that's when we start to see the turnaround in the markets, even though we all knew it was coming. There wasn't really an upset here. The committee decided to continue to reduce the monthly pace of its net asset purchases, okay, bringing them to an end in early March. Beginning in February, the committee will increase its holdings of Treasury securities by at least 20 billion per month and of agency mortgage-backed securities by at least 10 billion per month. So this was for quite a while 80 billion and 20 billion respectively. So, it's come down a lot, and then it should be gone come March. Now, if we look at this balance sheet, okay, we look at it, it shot up the end of 2008. It absolutely had to. This was necessary. Things were going absolutely horrifically. it never really tapered off much. It continued to go up because what happened then? 2013, 2014, which we want to speak a little bit about today because Jerome Powell, the Fed, seemed to be taking a very similar approach to the 2013, 2014 situation, which was very good for the stock market. And it went up and up and up, okay, a lot. And then they barely tapered off at all until 2018. And again, a lot of people are going to be aware of what happened in 2018 with rates and things of the likes. And then boom, 2020 hit and it had to go back up. Powell suggests Fed will follow the 2013 to 2014 playbook when it starts to taper its asset purchases. That means a tapering of asset purchases will come well before any rate increases. So the Fed didn't really begin to taper until 2015, and you can see it was extraordinarily slow. I mean, it pretty much stayed stagnant. Nothing really happened in either direction. So I don't think this can be compared to 2013, 2014 because we are going to get a rate hike, 95% plus likely to happen in March. And we're expecting quantitative easing to be done by then and potentially to start trimming that balance sheet. So it's not directly comparable anymore to 2013, 2014 as Powell has suggested in the past. And as well, we see GDP growing at a near 7% pace. That again is not comparable to 2013, 2014. It's a very different time. 2013 was a so-so time for the US economy, but it was a banner year for the stock market, okay? It was the best year in 16 for the S&P and in 18 for the Dow. I mean, it was an absolutely huge year for stocks despite, the US economy not being anything crazy. So the principles for reducing the size of the Federal Reserve's balance sheet. So since I'm already kind of seeing that it's not comparable to 2013, 2014, what is actually going to happen, okay? The committee will determine the timing and pace of reducing the size of the Federal Reserve's balance sheet so as to promote its maximum employment and price stability goals. So again, all of it falls in line with the Fed's greater goals. The committee expects that reducing the size of the Federal Reserve's balance sheet will commence after the process of increasing the target range for the federal funds rate has begun. So again, we're kind of walking around the questions that investors really want to know the answers to. The committee intends to reduce the Federal Reserve securities holdings over time in a predictable manner, okay? So maybe that is the most important sentence we get from this all. That essentially says that we're not going to get left in the dark as investors, and we are going to have a good idea of when these things actually begin happening and how they are going to happen. Over time, the committee intends to maintain security holdings in amounts needed to implement monetary policy efficiently and effectively in its ample reserves regime. Makes sense. They don't want to do a full 180. They don't want to purposely bring markets down. So why do we need, rate hikes? Why is that a thing? Higher rates could address inflation by raising borrowing costs and dampening demand, particularly for goods. We know that the Fed wants to bring inflation back down towards 2%, okay? That is why these rate hikes have to happen. That's why, it's expected there could be 4 to 6 rate hikes altogether this year. The first one we're expecting a quarter basis point. We're going to have to wait and see what happens. The thing is, the markets don't like uncertainty. And although we can expect what we want to expect to happen in March, although we can have educated guesses, although we can look at all the economists and strategists in the world and we can see what they have to say, we can see the general consensus, we can read into every sentence that Jerome Powell has to say, we won't know exactly what's going to happen until March, and then till the month after at the next FOMC meeting, and until we get the next statement. There's going to be a lot of uncertainty this year, okay? It really is looking that way. There's potentially more uncertainty now than there was even mid-2020, particularly the last quarter of 2020, we'll say, which is never good for markets. The difference is, right now, a lot of stocks are in better positions than they were back then, and valuations for a lot of these companies are actually better as well. So my plan is dollar cost average slowly but surely into these positions that look like they have good outlooks, preferably ones that have decent balance sheets that can survive another tough year or two, which is what we've been saying since 2020 at the end of the day. And just taking advantage of these dips, taking advantage of the sales, because they don't always come around. I know it seems like they do over the last 2 or 3 years, but historically, that's not really how it works. But anyway, my friends, I hope I was able to give you some valuable information in this video about the Fed. Hope I was able to make it easy, because I know it can seem really complicated for little to no reason sometimes. But yeah, a large reason that we're going to sell off is just due to uncertainty and due to the fact that economy and jobs are in a better place than they were a while ago, which means that the Fed don't have to help us investors out as much. Again, guys, if you would like those 5 free juicy stocks valued up to $3,500 each potentially, hit that first link in the description and check that comment for the pinned comment. I really would appreciate it. And I mean, it's free money, baby. Who doesn't love free money? I know I do. Drop me a like if you enjoyed this video. Drop me that comment. Subscribe if you're new around here. I hope you have a beautiful, blessed day. You, my friend, are a true legend. You right there. I'll see you in another video very soon. Peace.